Hello everybody, it's Zach here from realestatelicensewizard.com. Today we're doing our National Real Estate Practice Exam. Today we're doing part 2 of our 2022 version. One thing I want to mention that I forgot to do in the first video is this is the National Real Estate Practice Exam, which means, yes guys, it's good in all 50 states. So it doesn't matter where you're taking your exam, Florida, California, Colorado, it all applies. Now, a couple other quick things I want to go over. If you haven't watched the first half of this video series, I highly encourage that you do because I'm going to be referencing things that we covered in the first video. Also, if you want to follow along, you can grab a paper and pencil and do it that way, or check out our website. There we have a free version of this practice exam as well as a load of other real estate exam prep content. And then lastly, please like the video and subscribe if you really want to help us out. YouTube also just added this super thanks feature where you can show us appreciation that way. A little help goes a long way so we can create more content for you guys. Anyways, guys, buckle up, grab some paper and pencil, and maybe some popcorn too, and let's get started. All right, question 51. Which situation is legal under the Federal Fair Housing Act of 1968? Choose the best answer. Okay, A, the insistence of a widowed woman on renting her spare bedroom only to another woman. B, the intentional neglect of withholding certain properties to your clients to buy for yourself. C, the refusal of a property manager to rent an apartment to a Catholic couple who are otherwise qualified. Or D, the ability to buy property with the intent to resell it to your mother-in-law for double the price. So again, it's asking which situation is legal under the Federal Fair Housing Act of 1968. So like always, I'm going to give you guys a brief opportunity to think it over, read it over again, and come up with your answer. So go ahead and do that right now. Alrighty, so hopefully you came up with your answer, and hopefully it's the right answer. So what is the correct answer for this one? Well, it's going to be option A, the insistence of a widowed woman on renting her spare bedroom only to another woman. So the Federal Fair Housing Act is a law that prohibits discrimination of buying, selling, renting, or financing of housing. Now, these laws prohibit discrimination based on race, religion, color, sex, disability, children, nationality, and more. You cannot have a listing that states looking for Catholics only, or white people only, or whatever else it might be. The interesting thing, though, is you can put language referring to sex. For example, a seeking female roommate. Obviously, it's a case-by-case scenario, but this is a case of the Mrs. Murphy exemption, which essentially provides that if a dwelling has 4 or fewer rental units and the owner lives in one of those units, the home is exempt from the FHA. So Mrs. Murphy is the hypothetical elderly woman who was converted a portion of her home into a rental apartment to supplement her limited income. So again, you need to be aware of obviously the Federal Fair Housing Act, but then also these exemptions as well. And that's where this example A comes into place. That would be one of those exemptions. But yeah, so hopefully that makes sense. And then another question I get about this question all the time is obviously, it's asking which situation is legal under the Federal Fair Housing Act of 1968. So, option D, the ability to buy property with the intent to resell it to your mother-in-law for double the price, that might technically be legal. It might be unethical, but it might be legal. But again, the question is asking which situation is legal under the Federal Fair Housing Act of 1968. And it says choose the best answer. So again, all these are choose the best answer questions. So you need to be as specific as possible and look at what exactly they want. All right, next question, 52. The Latin phrase ad valorem comes up often when we're talking about property taxes. What does ad valorem mean? And it gives us 4 options. A, value. B, added value. C, according to value. Or D, property value derived from assessment value. So like always, here's a brief opportunity for you guys to read it over and come up with your answer. Okay, so when it comes to ad valorem, we're talking about value. That's well known. But is it added value? Is it according to value? Well, the correct answer is C. It's according to value. So essentially, this Latin phrase comes up pretty much all the time when we're talking about property taxes, and that's why they always ask about it. According to value just means it's flexible and it depends on the assessed value of the asset, product, or service. An ad valorem tax is charged by state and municipal governments and is based on the assessed value of a product or property. Now, the most common ad valorem tax is the property tax, which is charged on real estate and personal property. So again, when you're looking at these options, just like the last question, some of these answers could technically you could make an argument. Oh, option A, it says value. Option B, it says added value. But no, again, they're looking for that specific according to value. That is the correct answer for this one, and hopefully you guys got that. Okay. Question 53. A double net lease is a rental agreement where it gives us four options. A, two tenants will split the rent. B, yearly taxes are doubled, but rent is cheaper. C, two additional costs will be added to your base rent. Or D, three or more additional costs will be added to your base rent. So like always, here's a quick opportunity for you guys to come up with the answer. Alrighty, so hopefully you guys figured it out. What is the correct answer for this one? Well, it's going to be C. It's two additional costs. Two additional costs will be added to your base rent. And that should make sense, right? It's a double net lease. Double meaning two. Usually these two are taxes and insurance costs, but that can vary. Okay, next question, 54. What hazardous substance is odorless, colorless gas that can cause death within hours of inhalation? It gives us four options. A, radon, B, chlorine, C, formaldehyde, or D, carbon monoxide. So remember, if you're inhaling this, what is this? So yeah, think that one over. Here's some time for you guys. Okay, so hopefully you came up with the answer on this one. What is the correct answer? Well, it's going to be D, carbon monoxide. So yeah, I'm sure you've heard carbon monoxide is the odorless, colorless gas created from burning fuels. If the system is used correctly with proper ventilation, gas is controlled. However, if not, there could be immediate and serious health risks. If inhaled, causes red blood cells to deprive the body of oxygen. Extreme exposure cuts off oxygen and can cause death within 30 minutes or less. It's a good rule of thumb to use a carbon monoxide detector on every floor, especially with floors with an open flame. All right, next one, 55. Which of the following would be an example of a deed restriction? And it gives us four options. A, loan type. B, tax rate. C, house color. Or D, closing date time frame. So here's an opportunity for you guys to figure it out. Alrighty. Do you guys know your deed restrictions? Let's find out. So what is the correct answer for this one? Well, it's going to be C. It's house color. So deed restrictions are limitations to the use of the property imposed by a past or current owner and are usually legally binded forever or legally binding forever. So some common examples of deed restrictions are type and number of trees you can remove from the property, house color, window size, style, color, and construction materials used in the renovation. So you might be sitting there asking, well, what is the point of all that? Well, deed restriction comes into a lot of historical places, like maybe, there's a historical house that somebody owns and, they always want to keep, you know, the appearance or the certain presentation of that style, you know, present in the property. So they have these deed restrictions. Obviously, you know, there are other examples, but yeah, that's a pretty simple one. But yeah, so house color would be the correct answer, and that is definitely an example of a deed restriction. Okay, next question, 56. One individual or married couple in business alone. In parentheses, it says the most common form of business structure. Gives us four options: A, sole proprietorship; B, limited partnership; C, single cooperation; and then D, LLC or limited liability company. So here's a quick opportunity for you guys to reread it, come up with their answer, and find out, you know, hopefully the correct one. Alrighty, so this is a little bit of a two-parter. You could have figured this out one of two ways. One, obviously the one individual or married couple part, or two, the most common form of business structure. So hopefully you figured it out. The correct answer is A, it's a sole proprietorship. So a sole proprietorship is one individual or married couple in business alone. Sole proprietors are the most common form of business structure. This type of business is simple to form and operate and may enjoy great flexibility of management, fewer legal controls, and fewer taxes. However, the business owner is personally liable for all debts incurred by the business. A sole proprietor may purchase property for both personal and business use through his or her name and maybe the name of the business. However, only personal property used in direct relation to business operations is viewed as a tax-deductible business expense. So essentially, you need to be familiar with your business types, business structures, I mean, and we've covered this a couple times on this channel, but it's super important that you understand the differences in terms of, you know, if they can own property and how they own property, as well as taxation. Those things come up when you're talking about business structures all the time, so you do need to be aware of that. All right, next one. Question 57. What is the difference between a lease option contract and lease purchase contract? And it gives us four options. A lease option contract and lease purchase contract are the same thing. B, the difference between a lease option and lease purchase agreement is that the lease option only obligates the seller to sell. C, the difference between a lease option and a lease purchase agreement is that the lease option only obligates the buyer to sell. Or D, the difference between a lease option and lease purchase agreement is that one is for first-time home buyers and the second for is anytime home buyers. So again, here's a brief opportunity for you guys to come up with the answer and figure this one out. Okay, so hopefully you came up with the correct answer. So what is the difference between a lease option contract and a lease purchase contract? Well, the correct answer is B. The difference between a lease option and a lease purchase agreement is that the lease option only obligates the seller to sell. So obviously, with a lease option, the buyer is not forced to buy the property if they change their mind or, you know, cannot obtain financing. A lease purchase agreement commits both parties to the sale, barring breach of contract or the buyer's inability to secure a mortgage. So that's the difference there. All right, next one. Question 58. If a legal description is too long to include in the body of a sales contract, a real estate professional should do what? Gives us four options. A, ask their broker to verify the description because it should be short. B, write a second offer with just the legal description on it. C, attach it to the contract and make reference to it. Or D, just use the street address. So here's a brief opportunity to think that one over and come up with your answer. Okay, so what is the correct answer for this? So, if a legal description is too long to include in the body of a sales contract, a real estate professional should do what? Well, the answer is C. They should attach it to the contract and make reference to it. So, it is permissible to attach legal descriptions to a contract rather than writing them onto the contract themselves. But they must be attached. This is actually pretty common with sales contracts with extensive and large legal descriptions, and it makes sense, right? The goal of a lot of these sales contracts are to do the basic. I shouldn't say basic, but like the big meat of the problem and the transaction, essentially. The description, like the legal descriptions and stuff, that's more of an extra thing. So it's not necessarily it is a priority, but it's not. You know what I mean? So obviously the law knows this, so they put essentially a rule, and they made it legal that you can attach it to the contract and make reference to it. That's totally okay. So from a real estate professional perspective, you need to be aware of that, and you need to do that when the situation arises. All right, next question. Question number 59. What is a legal enforceable obligation that arises from one or more parties due to the party's actions, conduct, or circumstances? And it gives us four options. A, an executed contract. B, an express contract. C, an implied contract. Or D, an option contract. So here's an opportunity to think that one over and figure out the answer. Alrighty, so what is the correct answer for this one? Well, let's find out. What is a legally enforceable obligation that arises from one or more parties due to the party's actions, conduct, or circumstances? Well, that's most definitely going to be option C. I almost said number 3, so that's what I was like. But yeah, obviously it's option C. So an implied contract is a legally enforceable obligation that arises from one or more parties due to the party's actions, conduct, or circumstances. It has the same legal effect as an express contract, a contract between two or more parties that is willingly entered into and agreed upon verbally or in writing. But an implied contract is presumed to exist, but does not require written or verbal confirmation. So by definition, it's implied. And that's why this is kind of a tricky concept, and a lot of people struggle with, and that's why we actually do have a video as well as an article on this topic. But yeah, again, it's implied. It arises from one or more parties due to parties' actions, conduct, or circumstances. So it's implied. If you saw the definitions for the other three contracts on this list, it would make a lot more sense because those have definitive definitions. An implied contract, again, it's implied. It's kind of like it's like, oh yeah, like it's from circumstances, actions, conduct, things like that. Hopefully I explained that well enough. If not, I did do a deep dive on this topic, and I highly encourage you to check it out because it can be confusing. And if you don't understand, definitely study up on it. Okay, question number 60. Appraiser Leo was hired to prepare a feasibility study for a 12-unit apartment complex in which the owner is considering putting in a swimming pool. Which basic principle of appraising should Leo use? And it gives us four options. A, condemnation. B, reconciliation. C, contribution. Or D, closing. So here's a brief opportunity for you guys to come up with the answer and figure this one out. Okay, so what basic principle of appraising should Leo use? Well, Leo should definitely use option C, which is contribution. So, Leo should use contribution. Contribution is most commonly applied to determine how renovation and property changes may affect the property's overall cost. In this case, since the owner wants a feasibility study, contribution would need to be used. Swimming pools are a common contribution example. It's worth noting the cost doesn't always equal the value to a home. For example, a pool could add $5,000 of value to the house, but maybe it costs $10,000 to build. Make sense? So yeah, when you see these things, when you see this, is they're considering doing an add-on and things like that, and they potentially, again, a feasibility study, you should know that that's contribution. Yeah, cool. All right, so next one, question 61. The EPA requires real estate professionals to give purchasers and tenants of residential dwelling a pamphlet about lead-based paint if the dwelling was built before when. And it gives us 4 options: 1968, 1978, 1983, or 1992. So 4 dates. 4 dates. So here's a quick opportunity for you guys to think it over and figure out the answer. Alrighty. When you think of lead paint, what do you think of? You should think of 1978. That is what you need to think of. Lead-based paint disclosure rule, section 1018 of Title X, requires that potential buyers and renters of housing built prior to 1978 require certain information about lead and lead hazards in the residence prior to becoming obligated to buy or rent, and provides the opportunity for an independent lead inspector for buyers. So yada yada yada. What's important is that you remember that date, 1978. 1978. Remember it. It's got to be engraved in your brain because it's so important. You know, this comes up all the time, not just on the exam, but in your career. So please, please, please remember 1978, and obviously the lead-based paint and, you know, the pamphlet and all that stuff you need to be aware of. Okay, next one. Question number 62. The time is of the essence contract clause in real estate contracts generally has to do with what? Gives us 4 options. A, lease, B, recording, C, performance, or D, delivery of title. So here's some time to come up with your answer. Okay, so when you hear the term, or phrase, I should say, time is of the essence, what do you think of? What is it, guys? Well, the correct answer is C. It's performance. So you need to think about performance. So it generally, pretty much almost all the time when we're talking about real estate and contract clauses, has to do with performance. So time is of the essence clause, or the time of the essence clause in real estate contracts, refers to a clause that requires one party in a real estate contract to fulfill their obligations within a specific time frame. So again, it's just essentially laying down the time frame for a particular contract or a particular real estate contract. So for example, it may be, you know, we need to, you know, you need to give me this disclosure form by this date. Or, man, that's not the best example. Maybe a better example would be, okay, we're going to be closing on this date. Yeah. So things like that. But again, it's time is of the essence. That is what that contract clause has to do with. Performance. Again, somebody performing a special action or doing something, things like that. Okay, next one. Question number 63. Philip has a contract with his neighbor Jessica for lawn service. Philip can no longer mow the lawn due to an ankle injury. Paul, Jessica's other neighbor, agrees to carry out the terms of Philip's contract. In order to do this, Jessica must substitute Philip's name with Paul's on the contract. What is this an example of? And it gives us 4 options. A, an option, B, an novation, C, an addendum, or D, an amendment. So take a quick opportunity to think that one over and come with your answer. Alrighty. So in order to do this, Jessica must substitute Philip's name with Paul's on the contract. What is this an example of? Well, it's going to be option B. That's right, novation. So, novation is the procedure in which an original contract is terminated and replaced with a new one. The legal process of novation makes it possible to transfer all contract benefits and liabilities from previous parties to a set of new ones. In plain terms, it's a simple way to replace an old contract with a new one while maintaining most or all of its original properties. When you see any name transfers, just think of novation. Name transfers, novation. Say it with me now. Novation, name transfers, novation, name transfers, novation, name transfers. Okay? Just do that. Do that 10 more times. You know, when you finish this video, just think of that. I want you to hear that. I want that commented. I want that said all over the place, okay? All right, next one. Question 64. Which of the following best describes a balloon payment? And there's 4 options. A packaged mortgage. B, a small monthly payment. C, a variable mortgage cost. Or D, a large payment during the term or at the end of the payment schedule. So take some seconds to figure out the answer, and we'll talk about it soon. Alrighty. So, which of the following best describes a balloon payment? Well, for this one, the answer is going to be D, a large payment during the term or at the end of the payment schedule. So, if you guys have been following along since the first video, which I hopefully all of you guys have been, obviously we talked about this. We talked about balloon loan and how it works. And, you know, essentially a balloon loan is just different because not all payments are equally divided, and the most substantial payments are called those balloon payments. So again, it gets its name because it's a big payment. It's a balloon. It's the size of a balloon. It's massive. It's a big payment. All right, next one. Question 65. What is the total quantity that buyers are willing to buy at a given time at certain prices? Choose the best answer. So there's A, price, B, supply, C, demand, and then D, buyer's total. So take an opportunity, a couple seconds to come with your answer on that one. Alrighty, so this is an economic principle, and it's super important to understand. Like, I can't stress how important this is to understand. If you guys do not understand this, please watch my real estate economics video. It'll explain everything, and hopefully you'll get it. So the correct answer for this one is going to be C. It is demand. Demand is an economic principle referring to a consumer's desire to purchase goods and services and willingness to pay a price for a specific good or service, holding all other factors constant, which in Latin is ceteris paribus. I butchered that pronunciation. I think I've butchered it 3 years in a row, but you guys aren't here for my pronunciations. You guys are here for my bad jokes, right? Just kidding. Anyways, that's 3. I made three bad jokes. I decided I'm just gonna do 3 this year, so that's it. Or maybe I'll do another one. Maybe you guys have to watch the whole video to find out if I do one more. Okay, anyways, so yes, supply and demand, super important. Hopefully you guys understand that by now. If not, again, we do have videos on that. No big deal. All right, next one, question 66. A seller tells the listing agent that her home was treated for termites 5 years ago and that there are no termites now. Before listing the property, the agent should, gives us 4 options. A, tell the seller not to disclose the information since it's been past 2 years. B, tell the seller not to disclose information since it's been past 4 years. C, tell the seller to disclose the termite treatment on the property disclosure. Or D, contact the zoning department for local termite laws and ordinance. So take a moment to figure this one out. So go ahead and do that right now. Alrighty, so before the listing, the property agent should do what? Well, the correct answer for this one is option C. Tell the seller to disclose the termite treatment on the property disclosure. So the agent should tell the seller to disclose the termite information on the property disclosure. Now, whether legally required or not, because that depends on the state that you live in, you should always tell the seller to disclose termite damage, regardless of the legality. Letting buyers know about pest issues up front protects anyone from a lawsuit down the line. Even with as-is sales, you need to disclose any known termite damage on the property. So this is one of those questions where it's like, it's a real estate ethics question essentially, and it's asking you, what would you do in the situation? And obviously you need to do what you think is the right thing. And obviously the right thing here is to tell the seller to disclose the termite treatment on the property disclosure. So yeah, you should do that. And again, it's just one of those, ethics questions that you really need to think, okay, or let me pose it this way for you guys. What do you think the real estate commission in your state or the local government would want you to do? Think about it like that. If you think about it like that, like what would they want you to do? I think that these concepts, especially with like the specific ethics, I think the answer presents itself. At least it did for me, and for some other students that I've discussed this with. So yeah. Anyways, that should be it for that one. Okay, question 67. Joint tenants with a right survivorship or right of survivorship means, and here's our four options. A, co-owners have unequal interest in the property. B, if one owner dies, that owner's family has an interest in that property and can absorb it. C, if one owner dies, the other owner must sell his half and they divide the interest among themselves. Or D, if one owner dies, the property's interest in the property will pass to the surviving owner or owners. So take a quick opportunity to think this one over and come up with the answer. Alrighty, joint tenants with a right of survivorship. What does that mean? Well, the correct answer for this one is D. If one owner dies, that owner's interest in the property will pass to the surviving owner or owners. So, when a property owner, keep messing up here. I apologize. What are we at? We're 67 questions in. Okay, I got this. When a property is owned by joint tenants, the interest of a deceased owner automatically gets transferred to the remaining survivor owners. For example, if 3 joint tenants own a house and one of them dies, the 2 remaining tenants each obtain 1/2 of a share of the property. That is called the right of survivorship. So this is one of those ones, again, you need to be familiar with your tenancy laws, how joint tenancy works, especially the right survivorship, because that does come up all the time. So hopefully you got that one. Okay, question number 68. If a buyer refuses to go ahead with a purchase of property, which he has signed a contract, what usually happens to the earnest money? So if a buyer refuses to go ahead with a purchase of a property, which he has already signed a contract, what usually happens to the earnest money? And it gives us 4 options. A, it is kept by the seller. B, it is kept by the buyer. C, it is kept by the escrow company. Or D, it is split between the escrow company and the seller. So take an opportunity to think this one over and come up with your answer. Okay, so I'm really curious if you guys are going to be able to get this one, because this, to me, I don't know, this was a little tricky to me to understand and stuff like that. So, okay, what is the correct answer? Well, it is A. It is kept by the seller. So the seller is usually entitled to keep the earnest money. because this is considered forfeiture of the contract. The only way the buyer can back out and get their earnest money is if something happens with the inspection, appraisal, or they have a contract clause offering that protection. So this is another one of those questions where you need to think of the general rule applies. They don't specify if there's an inspection, appraisal, contract clause, anything like that. Generally speaking, if none of those rules apply and none of those exceptions are in place, generally speaking, it is kept by the seller. But again, most people or most agents, they do factor these things in, and that's why they include those contract clauses, and that's why it's super important to include those contract clauses, or else it can be kept by the seller. But yeah, generally speaking, if it's just a plain and simple, the buyer signs it, but they refuse to go ahead with the purchase of the property, then yeah, that the seller is entitled to keep that earnest money, and I think that that's pretty fair. We don't need to discuss the fairness of it, but yeah, just be aware that again, it is kept by the seller unless there's that extra contract clause or protections. But again, they didn't mention that in the question, so it is kept by the seller. Okay, question number 69. Which business structure traditionally features a board of directors? Gives us 4 options. A partnership, B, sole proprietorship, C, cooperative, or D, corporation. So take a brief moment to figure this one out. Okay, so if you're following along from earlier, we talked about sole proprietorship. I can't remember if it was at the beginning of this or in the first video, but we did talk about that. So knowing that, you could kind of rule that one out. So what is it? What is a business structure traditional features a board of directors? Well, that's most definitely going to be a corporation. When you hear board of directors, think corporation. So corporations, they can be formed for profit or nonprofit purposes, but basically they're managed and operated by a board of directors. A corporation has certain rights, privileges, and liabilities beyond those of partnerships. Doing business as a corporation has advantages and disadvantages. The biggest disadvantage, which you'll always hear about, is the double taxation. You might have even been hearing about that in the news because that comes up with all these corporations, stuff like that. But it's essentially a corporation is a legal entity that they must pay profits towards. So dividends from the remaining corporate profits are then distributed to shareholders and taxed again, and that's essentially, again, the double taxation thing. But for us right now in this question, just when you think of board of directors, think of corporation. Board of directors, corporation. And then obviously we talked about sole proprietorship before, being that individual one with not that much protection. But again, when we're talking about protection, you're getting into that LLC corporation area, things like that. Okay, next one, question number 70. In order for a month-to-month tenancy to be legally valid, which of the following must the contract include? Gives us 4 options. A, oral or written consent. B, offer and acceptance. C, consideration. Or D, all of the following. So take a moment to figure this one out. Okay, so in order for a month-to-month tenancy to be legally valid, which of the following must the contract include? Well, the correct answer might surprise you. It's going to be all of the following. It's answer D. So a month-to-month is a periodic tenancy that doesn't have an expiration date and thus runs indefinitely. Since a month-to-month tenancy is a real estate contract, it must have consideration, offer and acceptance, legal object, and competent legal parties. If it's for less than 1 year, it can be oral with some exceptions. So obviously, yeah, guys, when we're dealing with these real estate contracts, even in a month-to-month tenancy scenario, in order for it to be legally valid, it must include all of the regular, specific rules that we've discussed before. Contract obligations or things needed in a contract, or essential elements. That's what I normally say. Essential elements of a contract. It needs to include all of those. And by now you should know those. If not, we do have videos on that all over the place, as well as some articles. Okay, question 71. Altering a written document by improperly signing someone else's name to the instrument is what? And it gives us 4 options. A, forgery. B, usury. C, altercation. Or D, puffing. So take a quick moment to think about that one and come up with your answer. Okay, so when you hear a written document being improperly signed, that is, again, forgery. That's just one of those things when we talk about fraudulent activities and things that you shouldn't do as a real estate agent, and essentially just, again, the law is covering their butts here. They're making sure that you know everything that's wrong and not to do it. But yeah, so obviously forgery is just that. It's illegal, and real estate agents, again, they have to be aware of this. They can't do it. You cannot do this. It's bad. Okay, 72. While the economy is experiencing inflation, interest rates typically, and it gives us 4 options. A, drop and housing prices rise. B, rise and housing prices drop. C, rise and housing prices rise. Or D, none of the above. So take a quick moment to think this one over and come up with your answer. Alrighty, did you get it? Hopefully. So this is a pretty tricky question, and I know I said this about a bunch of questions, but I am really curious how many of you guys get this one. So the correct answer for this one is C. While the economy is experiencing inflation, interest rates rise and housing prices rise. So housing prices tend to rise with inflation. While the economy is experiencing inflation, interest rates typically rise and housing prices rise. There's a correlation between inflation and housing prices. In fact, there are correlations between inflation and any good with limited supply. When interest rates are low, buying homes can be more affordable and increase the demand for homes. If the supply of homes remains constant and the demand increases, then the prices of homes will increase. So again, this is another one of those real estate economics concepts that you do need to be aware about. And while we're living in this 2022 realm that you can call it, maybe you did hear about this, where we are experiencing a lot of inflation and there's a lot of uncertainty with a lot of things, but that's not the point. The point I'm making is you do need to understand how economics perspective works with dealing with these interest rates and inflation, because again, especially when you're an agent, that is going to come up. I'm sure you're going to have clients that are waiting or want to buy at certain times, depending on how the economy's looking and stuff like that. So that's why you need to be aware of it for the exam and for your career. Okay, next one. Question 73. What is the difference between void and voidable contracts? Choose the best answer. Okay, A, they are one and the same. The two terms can be used interchangeably. B, voidable contracts are only used on residential property, while void contracts can be used in any real estate related transaction. C, void contracts are not contracts, while voidable contracts have the necessary elements to be enforceable, but they can be rejected by one party. Or D, voidable contracts are not contracts, while void contracts have the necessary elements to be enforceable, but can be rejected by one party. So take a brief moment to think that one over, read it over if you need to, pause, all the good stuff, and come up with your answer. Okay, so remember earlier, I think in the first video, I said, guys, you need to be aware of the void, voidable, valid, like all that stuff. Well, guess what? It showed up again. So let's see who figured this stuff out. So the correct answer, what is the difference, is C. Void contracts are not contracts because they lack an essential element of a contract and are thus unenforceable. Now, voidable contracts have the necessary elements to be enforceable, so they appear to be valid, but can be rejected by one party if the contract is discovered to have any number of defects. So again, you need to be aware of these differences because I swear I should get this tattooed on my arm, but it shows up on the exam, so you do need to be aware of that, very much so. Okay, 74. Typically, a trust is a blank party relationship, and there's 4 options. A is 1, B is 2, C is 3, and D is 4. So take a brief moment to think this over and come up with your answer. Alrighty, so typically a trust is a C, 3-party relationship. So trusts, we talked about this a little bit earlier. They can be made in an individual's lifetime or established following someone's death. But a trust is a 3-party relationship in which the party or the trustor transfers a party upon the second party for the benefit of the third party, the beneficiary. The trustee is that second party, and they are required to manage the trust in accordance with the trustor's wishes and in the beneficiary's best interest. So a good way that I remember this is when I think of trust, I think of tri, which means 3. I don't know if that'll work for you. If not, no big deal. But that's what I think of. So tri, 3, trust. That's the way I look at it. All right, next one, 75. All right, mortgage points, also known as discount points, gives us 4 options. A, discounts on interest rates granted from the government. B, discounts on down payments granted from the government. Or C, fees paid directly to the lender at closing in exchange for a reduced interest rate. Or D, fees paid directly to the lender at closing in exchange for a reduced down payment. So take a moment to think this one over and come up with your answer. Okay, so what are mortgage points? Well, that's going to be option C. Fees paid directly to the lender at closing in exchange for a reduced interest rate. So, the interest rate decreases, not the down payment. Obviously, that's worth noting. But these are great options for somebody who knows they'll be owning a specific property for a long time. Mortgage points are essentially directly paid to the lender or bank at closing. But yeah, they're just fees paid directly to the lender at closing in exchange for a reduced interest rate. Pretty straightforward. Okay, question 76. As a general rule of thumb, all written offers must, and here are 4 options. A, sent must be, I'm sorry, let me reread that one again. As a general rule of thumb, all written offers must be sent to the local government authority. B, presented to a broker's local's office. C, presented to the seller. Or D, presented to the buyer. So that one was worded a little bit weird. I apologize. But yeah, so as a general rule of thumb, all written offers must be what? And then it gives us those 4 options. So take a moment and think that one over. Okay, so when you hear offers, you should think sellers. essentially, because you, again, in this circumstance, I mean, let's be honest, you'd be presenting that to the buyer. You wouldn't be, or I'm sorry, the seller. See, even I'm mixing it up. I apologize. So yeah, again, you got to think of the seller's perspective, not the buyer's perspective, because it makes sense. If you're buying a house, you're not receiving offers for the house. But if you're selling the house, you're going to receive multiple offers. Now, from our perspective as professionals, the general thumb is that all written offers must be presented to the sellers. It is a serious breach of a real estate agent's fiduciary duty to not present all purchase offers. So if an offer comes in really low and you're like, oh, well, they shouldn't take this, that doesn't matter. You need to present it to the seller. Again, that is a breach of the real estate agent's fiduciary duty if you do not present that offer. Okay, question 77. What is the difference between a testate estate and an intestate estate? Choose the best answer. A, an intestate estate means that the trustor is in charge, while a testate estate means that the trustee is in charge. B, an intestate estate means that the trustee is in charge, while a testate estate means that the trustor is in charge. C, an intestate estate means that the descendant left a will, while a testate estate means that the descendant did not leave a will. Or finally, D, a testate estate means that the descendant left a will, while an intestate estate means that the descendant did not leave a will. Woo! Try and say testate estate, intestate estate like 10 times really fast, because it's almost like impossible. But I almost just did it, so yeah, props to me. No, I'm just kidding. Anyways, all right, so think about that one, come up with your answer, and let's see what you guys got, and then we'll discuss. All right, did you say it 10 times really fast? Testate estate, intestate estate. See, I'm still messing up. A testate estate and an intestate estate. It helps me if I just say it really fast. I don't know. Anyways, so what's the correct answer for this? What is the difference between a testate estate and an intestate estate? Well, the difference is option D. A testate estate means that the descendant left a will, while an intestate estate means that the descendant did not leave a will. So essentially, this comes up when somebody passes away. This term essentially is used in probate court, and essentially it just determines, or that's what they do to essentially determine the distribution of his or her property to the appropriate parties. First, they'll determine, okay, is it intestate or testate estate, and then from there they'll figure it out. But first is they have to distinguish, okay, is it testate estate or intestate estate? All right, next one. Enough of that question and those two words. Okay, question 78. Andrew created a life estate on his property for his sister Gabby. Under the terms of the deed, ownership of the property will last until, and there's 4 options: A, his death; B, her death; C, his moving date; or D, his last day of the fiscal year. So take a moment to think about that one and come up with your answer. Alrighty, so I love this question. I really do. I think this is a fun one. So Andrew created a life estate on his property for his sister Gabby. Under the terms of the deed, ownership of the property will last until. The correct answer is B, her death. So how many of you guys put A? I'm curious. That's frequently mixed up all the time. So when you hear life estate, you think life of death or life and death. A life estate is an interest in real property which is held for the duration of the life of a designated person. It may be limited by the life of the person holding it or by the life of another person. This designated person is called a life tenant. This is, again, kind of one of those trick questions. In this case, since Andrew created the life estate for his sister, she is the life tenant, meaning it will last until her death. See right here, Andrew created a life estate on his property for his sister Gabby. That's the clue there. That's how we figure it out. That's how we know it's her death. All right, question 79. Holding earnest money without depositing it is what? And it gives us our four options. A, always illegal. B, legal with written authority. C, legal with verbal authority. Or D, legal if held by a broker. So take a moment and think that one over and come up with your answer. Okay, so holding earnest money without depositing it is what? Well, the correct answer is B. It's legal with written authority. So holding earnest money is only legal with written authorization. And even though it's best to deposit as soon as possible, even with that written authorization, having verbal authority is not good enough, and in many states is considered illegal. So again, you need that written authority if for some reason you are holding that earnest money without depositing it. But like I said, it's best to deposit as soon as possible, pretty much like 99.9% of the time. But obviously, like, if you're holding it with written authority for a brief amount of time, you need written authority essentially. Okay. Question 80. Which answer includes three actual types of business structures? Choose the best answer. Okay. A, Circula, LLC, ARP. B, general partnership, joint corporation, and sole company. C, sole proprietorship, joint partnership, share partnership. And then D, corporation, sole proprietorship, and limited liability company. So take a moment to think that one over and come up with your answer. All right. Did you guys study your business structures? Hopefully. What's the correct answer for this one? Well, it's most definitely D. We talked about corporation already. We talked about sole proprietorship already. We didn't talk about LLC yet, so I guess I'll talk about that a little bit. But essentially, an LLC is a hybrid legal entity that it has certain characteristics of both a corporation and a partnership or sole proprietorship. So that's why it's becoming increasingly very popular, because it offers a lot of the flexibility as a sole proprietorship or partnership, but it also offers the protections that a corporation has. So it's becoming very, very popular. So I encourage you guys, for those of you guys who do plan on, starting your own real estate business specifically and not working just under a broker, but to look into maybe getting an LLC, just to protect yourself and things like that. All right, next one. Question 81. A bilateral contract is one in which, and it gives us four options. A restriction is placed in the contract by two parties to limit the performance of the other party. B, the promise of one party is given in exchange for the promise of the other party. C, only one of the parties is obligated to act. Or D, something is done by only one party. So take a brief moment and figure this one out. Okay, so bilateral contract, what is that? Well, it's going to be option B. The promise of one party is given in exchange for the promise of another party. In plain terms, a bilateral contract is an agreement between two or more parties. Most business and personal contracts fall into this category. And we talked about this earlier when we talked about unilateral contracts. But remember, guys, remember your prefixes. Uni means one, bi means two, tri means three. I mean, those are all really good hints come exam time. I mean, they practically give you the answer if you just know how to break down the word. Okay, next question. A seller made a counter offer and gave 3 days for acceptance. The very next day, the seller receives a better offer, which they want to accept. What is the first step the seller should make? And it gives us 4 options. A, nothing, since the seller already made a counteroffer. B, withdraw the counteroffer. C, withdraw the offer. Or D, sign the new offer. So take a moment to think this one over and come up with your answer. Okay, so what's the first step? What's the first step the seller should make? What is it? Well, it's B. They should withdraw the counter offer. In the situation, the new offer cannot be accepted unless the seller's counter offer is withdrawn or hypothetically rejected. Remember, if a new offer is accepted, 2 valid contracts could exist. So the first step must be to withdraw the counter offer, because do not want to be in that situation where there's 2 contracts that exist. I mean, that would be a disaster. So yes, again, the first thing that you would need to do, or the first thing that the seller should do, is withdraw the counter offer. Okay, next one. Question 83. Who is most likely to win a suit for specific performance? A, the seller. B, the buyer. C, the real estate professional. Or D, all parties have the same odds of winning a suit for specific performance. So take a moment to think about this one and come up with your answer. All right. Are you guys ready to discuss some specific performance? So, for those of you guys who've been following along, again, we did talk about this in the first one a little bit. So, we didn't mention who is most likely to win a suit for specific performance, though. So, who is most likely to win? Well, the answer would be B. It's the buyer. So, specific performance, just recap, is legal concept that anyone who signs a contract is bound to the terms of the contract. Both the buyer and seller can sue for specific performance, but it's more common for a buyer to sue and win a suit on specific performance. The buyer is more likely to force the seller since the seller was the one who put the property on the market. So this is one of those tricky questions, guys. You just need to be familiar with, again, that specific scenario. It's like a scenario question. It's like you might never see this in your real estate career, but when it comes to the exam, you need to be familiar with all these scenarios and what the correct answer is. So yes, again, the buyer is more likely to force the seller, or I'm sorry, the buyer is more likely to force since the seller was the one who put the property on the market. And that makes sense, right? If they put the property on the market, I mean, their intent is to sell the property. So the buyer can sue if something comes up for specific performance, and again, they're most likely to win. Okay, question 84. A parcel of real property that has an easement over another piece of property is best described as, and it gives us 4 options. A servient estate. B, a dominant estate. C, an estate in sufferance. And D, an estate in tenement. So take a moment to think this one over and come up with your answer. Okay, so a parcel of real property that has an easement over another piece of property. What is that? Well, that's going to be B. It is a dominant estate. So, by definition, a dominant estate is a parcel of real property that has an easement over another piece of property. So, if you remember, earlier we talked a little bit about the serving estate and how it serves. It serves. It's a serving estate. While now we're dealing with the dominant estate. What does the dominant estate do? Well, it dominates. It dominates over the server. It dominates over the serving estate because it serves. One serves, one dominates. Does that make sense? Hopefully. At least that's what helped me and a lot of others figure it out. But yeah, just remember those two terms and the relationship. One serves and one dominates. Okay, question 85. When contracting parties have signed a contract and both parties have done all they promised to do, it is called this. It gives us 4 options. A, an executed contract. B, an express contract. C, an implied contract. Or D, an option contract. So take a moment, a couple seconds to come up with your answer. Alrighty, so when contracting parties have signed a contract and both parties have done all they promised to do, what is it? Well, it's executed. It's an executed contract. So essentially, it's called an executed contract or an executed agreement. It's worth noting that most contracts or real estate transactions specifically require execution. A sales contract, for example, is executed when the seller has transferred title to the buyer and the buyer has paid the seller. Execution must occur to finalize the agreement. Without execution, a transaction is incomplete and therefore doesn't exist. All right, next one. Question 86. A real estate commission is usually based on and there's our 4 options: A, listing price, B, selling price, C, earnest deposit, or D, amortization percentage. So take a moment to think this one over and come up with your answer. Okay, so a real estate commission is usually based on what? Well, the correct answer is going to be B. It's the selling price. So commission is paid to real estate agents, and obviously the commission itself is negotiable, but that percentage or sales price is based off of the selling price. So again, the percentage is a percentage of the sale price of the home, also known as the selling price. Now, again, technically speaking, guys, if we're playing technical game, technically there are different ways that a real estate agent can earn a commission. It could be based off of we have those gross leases, or different forms of contracts where it's not based off of the exact selling price, but 99.9% of the time it's going to be based off the selling price. So again, remember, what do you think is the most realistic, and what answer do you think makes the most sense, or should I say, what answer do you think applies to most situations? Yeah, I think that's a good way to put it. What answer applies to most situations? And we know for a fact real estate commission is usually based on the selling price. Okay, question 87. A buyer gave a broker a written offer to purchase property, which obtained a 14-day acceptance clause along with a $3,000 deposit. On the 7th day before acceptance by the seller, the buyer notified the broker that they were withdrawing their offer and asked for a return of the $3,000 deposit. Which of the following statements are true? A, the seller is entitled to the $3,000. B, the buyer cannot withdraw their offer. C, the buyer can withdraw their offer, but the $3,000 stays with the seller. D, the buyer can withdraw their offer as long as the seller did not accept the offer and the buyer can obtain the $3,000 deposit. So take a brief moment. This is a little bit of a lengthy one. Take a brief moment to figure it out and come up with your answer. Okay, I love this question, and here's why. There's different elements, and I'm going to break it all down for you guys. So, for starters, let's figure out the correct answer. So, what is the correct answer? Well, it's going to be option D. The buyer can withdraw their offer as long as the seller did not accept the offer and the buyer obtained the $3,000 deposit. So, this is all because the seller has yet to accept the offer. Again, remember, an offer isn't legally binding until it becomes a contract through acceptance. So, look at this. A buyer gave a broker a written offer. Nowhere it says on the 7th day before the acceptance by the seller, the buyer notified the broker they were withdrawing their offer and asked for a return. Again, it in this question, it never mentioned that the seller accepted the offer. So, when we were discussing things earlier, when we were talking about earnest deposits and all those situations, and how that question earlier was just asking the general the general explanation for what happens after. Well, this is a detailed explanation. This is this is one of those questions where they try and trick you. But again, it's just that the broker gave a written offer, and then there's a 14-day window. 7th day before acceptance, again before acceptance by the seller, the buyer notified the broker they were withdrawing. They're not doing anything wrong here. They put an offer. The seller had yet to respond to it, and they wanted to withdraw it. Yeah, they perfectly earned that return of that $3,000 deposit, because again, they did not sign. The seller did not sign the offer. They did not sign a contract. Nothing. So again, the answer would be D. So hopefully that makes sense, and I'm really glad that we got both those questions today, and from this video and the last, because hopefully you guys can see that difference, and it makes more sense for you. Okay, question 88. It is the blank's duty to explain the purchase agreement and to not mislead any parties. So take a moment to think this one over. Or I'm sorry, here are your options. A, the buyers. B, the sellers. C, agents. D, mortgage broker. So again, it says it is the blank's duty to explain the purchase agreement and to not mislead any parties. And it says buyer, seller, agent, and mortgage broker. So take a moment to think that one over and come up with an answer. Alrighty, so I think this one's pretty standard. This is one of those another ethical question. So obviously the answer is C. It's the agents. It is important that the buyer and seller clearly understand the documentation, as it becomes legally binding as soon as both parties sign. It is the agent's duty to explain the purchase agreement and to not lead or to not mislead both or either parties. So again, it's one of those ethical questions what they're quizzing you on to make sure that you believe and that you would do the right thing, because obviously you're not getting your license to mislead anybody. You're doing it hopefully for the right reasons. So all right, next one, 89. In real estate, a deed is best defined as, and it gives us 4 options. A written will signed by a lawyer. B, a written promise to one person from another. C, a declaration or assurance that one will do a particular thing or that a particular thing will happen. Or D, a written legal document by which ownership of real estate is conveyed from one party to another. So take a couple seconds to figure this one out. Alrighty, so in real estate, a deed is best defined as what? Well, it is D. It's a written legal document by which ownership of real estate is conveyed from one party to another. So for a deed to be legal, it must include the identification of the grantor and the grantee and the adequate description of the property. But yeah, when you hear written legal document and ownership being conveyed, just think of deed and sometimes title, which hasn't come up yet, but mainly primarily deed. The deed is the specific document itself. Title is a concept, is a legal concept, but I'll explain that later if you don't know that, or if not, we do have a video on deed versus title, which I highly encourage. It's one of my favorite videos that I ever made because I had so many people ask questions about it and I finally made it. So if you're struggling with that, check that out. Okay, next one. Question number 90. Appraiser Larry has a set of special purpose and public service buildings like schools, churches, and post offices, which he needs to appraise. Which approach to value would Larry, the appraiser, choose to complete the task? So he's got schools, churches, and post offices he needs to appraise. What should he do? So it gives us 4 options. A, the cost approach. B, the estate approach. C, the income approach or summation. And D, the market data approach or sales comparison approach. So take some time to figure this one out, and we'll discuss the answer in a moment. Alrighty, so this is another super fun one. Or at least it's fun to me. So what is the correct answer for this? So again, he's dealing with churches, schools, post offices, and he needs to appraise them. So which approach to value would Larry, the appraiser, choose to complete the task? Well, the correct answer is going to be A. It's the cost approach. So for special purpose and public service buildings like schools, churches, and post offices, the cost approach is the best choice. The reasoning is because these types of buildings usually do not have income. So again, the income approach is out. So we can just cross out C. And then there's not enough comparables to do the sales comparison approach. So again, the cost approach is the best answer. And that also makes sense, right? Because when you're looking at these cost factors, those are definitive things. Those are definitive things that you can find out. With the market data approach, again, like there's not. I mean, think about it. In your area, how many schools are built, right? Let's just say there's like 5 schools in your area. Okay. You know how incredibly hard it would be to find the market data for those 5 schools and then compare for the, like say 6 schools coming in, and because each one of the schools I'm sure was built and years ago and things like that. So yeah, point being is D, market data approach is completely out just because it's unrealistic, and then C, again, these things aren't necessarily making income, so they can't do the income approach. So the best answer for this one is going to be the cost approach, which is A. Okay, question number 91. When a furnishing company creates materials for the construction of a house and is subsequently not paid, it may file and it gives us 4 options. A, a mechanics lien. B, a furnishing lien. C, a financial lien. Or D, a bank lien. So take a moment to think this one over and come up with your answer. Okay, so this was a pretty easy one. We got a question that was very similar to this one earlier, so I won't go too much in detail, but obviously the correct answer is A, it's a mechanics lien. So like we talked about earlier, I think in the first video, we discussed what a mechanics lien is and kind of how it works. But basically, it's also called a construction lien, and it's just for non-payment of work done on the property. But yeah, so maybe if you hopefully you're taking the exam, you get one of those instances where, because they're technically 2 different questions, but they're ordered a different way. But how nice would that be if you got a question, 2 questions like that? But you never know, because again, I kind of went on that tangent in the first video, and I won't again. But this is why you need to learn all assets of it, or all facets of what to study. That way, because you never know, you might get 5 questions on one topic that is so minor, but that's just the way the exam generates. Because again, it's completely random. Every exam you take is going to be completely random on your come exam day. You could be taking an exam and the person right next to you could have way easier questions or harder. So that's why you have to really study hard for this thing. Okay, question 92. During your time as an agent, you will run into many different types of people across the world. Closing is called many names depending on which region of the U.S. you're from. Which of the following is not a legal name for closing? Okay, interesting. So there's A, settlement and transfer, B, exchange and transfer, C, passing papers, and D, closing. So take a moment to think this one over. Okay, so let's talk about closing. So, which of the following is not a legal name for closing? Well, that's going to be B, exchange and transfer. There's no such thing as that. Closing is known by many names. Some areas of the country may call it settlement and transfer. Some call it passing the papers. The textbook name is for closing is obviously closing, but you do need to be aware of these other terms depending on the state in which you live in. But also you need to be of the things that don't make sense. Like exchange and transfer doesn't exist. That's not a thing. So you need to be aware of the legal names, because again, that's what applies to you and that's what's important. Okay, 93. An example of functional obsolescence in real estate is A, outdated plumbing, B, a house not having a pool, C, a house in a lower class area, or D, an agent not being able to sell a property. So take a moment to think this one over. Alrighty, so what's the textbook example of functional obsolescence in real estate? Well, it's outdated plumbing. It's A. So I know some of you guys have some questions about this one, and let me explain. So functional obsolescence, first of all, refers to loss of property value due to an obsolete design feature. Outdated plumbing would be considered functionally obsolete because it's outdated. Now, who determines what is obsolete or not? Well, it's usually the buyer or homeowners. If a neighborhood is filled with houses with new bathrooms or new plumbing and yours isn't, it would be considered functionally obsolete. So now I know a couple of you guys are getting ready to type out a comment about option B right now, but let me explain. Okay, so a house not having a pool, that can be an example of functional obsolescence if other houses in the area have pools, but it does not mention that in this question. What does it mention? Outdated plumbing. That term right there gives it away. It's outdated. Now if this wasn't here and it just said plumbing, and option B was a home in a neighborhood without a pool with all pools, then yes, that would be this one. But again, guys, you have to don't think of things so black and white when we're doing these exam questions. They're very complex, sophisticated questions that somebody way smarter than us, maybe, or maybe not, came up with. They figured this stuff out. They tried to make it as tricky as possible for a reason. The reason this is confusing is because of this right here, outdated plumbing. A house not having a pool. Again, I can see the confusion, and that's why I wanted to really bring this up, because I have gotten comments about this question all the time, and I really haven't addressed it. But hopefully that makes sense. So again, when you're dealing with this question, look at context clues, look at these phrases, look at how they're describing it. It says here it's outdated. You already know it's outdated. That's your answer. That's it. It doesn't matter about any other choice. It says this is outdated. It could be, outdated carpet. It could be, something else. Again, an outdated pool. But the key term again is it's outdated, because that means it's functionally obsolete, essentially. So does that make sense? Hopefully. I know I went off on a tangent, but it needed to be said because I have comments about that all the time. So yeah, now we've addressed it. Okay, question number 94. An example of an antitrust violation is A, selling more than 100 houses in a taxable year, B, buying a house in another state, C, an equity loan, and D, price fixing. So take a moment to think this one over and come up with your answer. Okay, so what is an example of an antitrust violation? Well, obviously, this one's price fixing. I mean, we know that, should know that. Fixing is the practice of setting price of a good or service to make a particular price standard. So, excuse me. In our terms, real estate fixing is when competing agents meet up and agree on the same commission rates. So, totally wrong and totally an antitrust violation. Okay, 95. After smoking, this is the second leading cause of lung cancer in the United States, a naturally occurring gas that forms in rocks, soil, and water. So take a moment to think this one over and come with your answer. Okay, so the silent killer. What is the silent killer? Well, it is A. It's radon. It is radon. So after smoking, this is the second leading cause of lung cancer in the United States, radon. So again, it's just one of those environmental factors that you need to be aware of, and hopefully now you are. Okay, 96. An offer to purchase real estate becomes a contract when it is signed by the, and it gives us four options: A, seller, B, buyer, C, buyer and seller, or D, seller and the agent. So take a moment, think that one over, and come up with your answer. Alrighty, so an offer to purchase real estate becomes a contract when it is signed by C, the buyer and the seller. So obviously, there's a bunch of things that need to occur for a contract to be valid. We've talked about a lot of these things, so I won't go too much in detail. But mutual consent is a big one. That's part of the four, essential elements of a valid contract: mutual consent. So any offer to purchase real estate must be signed by both the buyer and the seller in order for it to be valid. And both parties must follow these guidelines. It becomes a legal contract as soon as both parties sign. So I know this is a little bit of a tricky one for some people. Some people might think, oh, well, because it's an offer, maybe it's the seller. But again, in some perspectives, the buyer already signs that, offer. So again, it's kind of a trick question. Or maybe the seller gets it and then they sign it and then the buyer signs. Depending on how the contract is laid out. But in a lot of times the buyer just signs the offer, and then when they present it, the agent and the buyer present it to the seller, then they sell it. Either way, both people are signing it. Again, that mutual consent for a contract is an essential element. It has to occur. Both parties must follow these guidelines. But yeah, so hopefully you get that. Okay, question number 97. Which of the following best describes the prepayment penalty clause? And it gives us four options. A provision in a mortgage or deed of trust signed with a lender that states that the borrower must pay the mortgage in full before the borrower can transfer the property. B, A contract provision that requires a borrower to repay all of an outstanding loan if upon breach of a contract. C, the statement that a lender can penalize a borrower if the borrower pays off the mortgage much sooner than usual. Or D, a contract provision in real estate that establishes the order of priorities of financial claims. So take a moment to think that one over and come up with your answer. Alrighty, so what is the answer for this prepayment penalty clause question? Well, it's going to be C. The statement that a lender can penalize a borrower if the borrower pays off the mortgage much sooner than usual. So luckily for you guys, we talked about this one already. But again, we talked about prepayment penalties a little bit earlier. So I won't go too much in detail. But yeah, out of 100 questions, I think we only got a couple on contract clauses. But just so you guys need to be aware, you need to know like a lot of contract clauses, like tons. So we have a video on that, and if you go to our website and take this practice exam, like I said, you can take this one or our free one, things like that. More questions will come up about contract clauses because, again, it randomly generates the questions just like the real exam, and you never know. But point being, you need to know your contract clauses, so please figure that out if you do not know it. Okay, question 98. According to the Do Not Call list and Established Business Relationship (EBR) rules, how many months does a real estate professional have to call an expired listing client to solicit new business, in parentheses, referral? And there's 4 options. A, 18 months, B, 6 months, C, 3 months, D, indefinitely. So take a moment to think this one over, and then we'll figure it out. Okay, so this is an interesting thing that you need to know. You need to be familiar with the Do Not Call list and the Established Business Relationship rules. Federally, it's a big issue, and it's come up in the news a couple times within the last couple years, actually. Side note. But anyways, you do need to be familiar with these months. You need to be familiar. There's 3 questions, and obviously we don't have all of them in front of us, but there's really 3 big ones that you need to be aware of. You need to be aware of essentially expired listing clients, um, new clients, and then I believe the other one is past clients. So yeah, expired, past clients, and then new clients. And essentially, you need to know what the time frame is for each one of these, if any. And essentially, for this one, we're dealing with expired listings. So again, how many months does a real estate professional have to call an expired listing? And in this one, it would be A. It would be 18 months. So established business means a relationship between a seller and consumer based on, and then it has here in this explanation essentially the specific code that the federal law is. But essentially, it's the consumer's purchase, rental, or lease for financial transaction between the consumer and seller within 18 months. So again, yeah, it's 18 months. There's just one of those weird specific rules and laws that you need to be aware of. And again, as I mentioned, those three things come up. So definitely be aware of each one, and you should be good to go. Okay, question 99. Aaron can't get to his property from a public road without crossing over his neighbor Ron's property. In this situation, Aaron needs A/N, and it gives us 4 options. A variation from the local zoning board. B, a variation from the local zoning board and Ron. C, an easement for ingress and egress over Ron's property. Or D, equitable title transfer with the permission of Ron and the local zoning board. So take a moment to think this one over, and we'll talk about it in a moment. Okay, so what are we dealing with? What is Aaron dealing with? Well, if in this situation, what does Aaron need? Well, he needs an easement. C. He needs option C. He needs an easement for ingress and egress over Ron's property. So if Aaron can't get to his property from the public road, then he is landlocked. So he needs an easement for ingress and egress over Ron's property to be able to enter and exit the property. And I believe, yeah, we did talk. Maybe I'm sorry, it blurs all together. We've gone through almost 100 questions, but I believe we talked about ingress and egress rights. But if not, essentially, it's just entering and exiting a property. That's what ingress and egress essentially means. And again, for these situations, they would need an easement, which is, I don't know if we specifically discussed it either, but a right to do something on, someone else's property. But yeah, so that's it for that one. And question 100. Okay. Justin takes out a mortgage loan that requires monthly payments of $650.50 for 25 years and a final payment of $30,000. What type of loan is this? And it gives us 4 options. A, FHA loan, B, balloon loan, C, fixed rate loan, or D, a variable cost loan. So take a moment to think about this one, and then we'll discuss it. Alrighty, so what is our correct answer? I'm sure you guys are probably tired of hearing about it. It's B. It's a balloon loan. So again, we happen to get 2 or 3 questions about balloon loans and balloon payments in this round. But again, that's natural. And if you've watched every single one of these videos, in terms of like 2019, 2020, 22, you know that it's all random. So again, I'll emphasize it one last time. And if you're sitting next to somebody at the exam, they could have a completely different exam as you. They could get 5 questions in one topic and you could get 5 questions in another. It's just the way it works. So that's why it's important to diversify, understand, study as much as you can. I'm not going to push you away, but I encourage you to look at numerous resources. And I think that's why our website's so great, is because there's tons of resources on there. And not to shill that anymore, but seriously, it's a fantastic place to just look at multiple resources and study and figure out what's best for you in terms of study tools and how to study. But yeah, so that's going to be it. We did it. Fantastic job, guys. Give yourself a round of applause. Hopefully you guys enjoyed. If you want to study at your own pace, definitely check out our website, Real Estate License Wizard. There you can take our practice exam, which again, it's free. We have a free practice exam. We're one of the few sites that actually has like a legitimate free one, not just like 5 or 10 questions. We have lots of free questions on there. And then we also have study guides and other study tools. So definitely check this out. And yeah, if you really enjoyed this content, please give it a thumbs up and subscribe to our channel for more real estate exam related content. Anyways, guys, this is Zach from realestatelicensewizard.com. Thank you so much for spending time with me today. I really appreciate it. As always, make today magical. Good luck on your exam if I don't talk to you until then. Bye.